Hello, fellow traders. 'Tis I, the Rumpled One, coming to you on Tuesday, November the 4th. The year's 2025. Let's talk trading, old school trading. These videos are for educational purposes only. Your results may differ from mine. As always, let's have risk management in place so we don't lose more than we're willing to lose at all, whether it's on a trade or during a trading session. Old school trading. I've been pondering a thought, and I may have mentioned it yesterday. I was talking to Walmart about it. How did traders learn, 100 years ago? What were they studying? Because they certainly weren't studying indicators or high frequency trading or online trading. They didn't have these tools. So, what did they do? They produced charts by hand. But it's interesting because I then went out to Google and it's like, how, and just basically asked, how did traders learn, 100 years ago? And one of the responses was, they had a mentor, somebody who taught them, and they watched. So then I thought, let me find some old trading books. And there's this one called The Magazine of Wall Street. And if I'm not mistaken, they're still publishing. But I found this edition and downloaded the PDF. It's not a full edition. It's just basically, I guess, some pages that were copied. But it's there's this one sentence that kind of stuck out for me. It says, and it is, the effort to reduce the science of speculation and investment to an impossible definiteness or an ideal simplicity is, I believe, responsible for many failures. And if you ponder that, something needs to jump out, or something just may jump out. And for me, when they talk about the whole idea of speculation, because that's what we're doing, we're speculating when we're trading. We think we're buying at the best price and we're going to sell at a better price, or we're shorting at a price and we're going to cover at a better price. And there's no definite. And I've said that before, but sometimes when you read it and it has the same meaning, but it comes across, it's presented slightly differently. It can stick with you. And it shows to me why it's true so many traders lose. I mean, when you think about the components of trading, what you can control and what you can't control the outcome. You can basically minimize your losses. Because sometimes you're going to guess wrong. And when I say guess, what I mean is you're going to enter with the expectation that the trade's going to go in one direction, and it never does. It never gives you the opportunity within your trading session to exit with a profit. Now, the thing is, when I say session, that could mean minutes, hours, days, weeks, months, or even years. And the only question is, so long as it doesn't violate your risk, your maximum loss, then you can stay in that trade. Because I had a trader reply on a video, something about 50-50. They were, only trading about 50-50. Well, if you're trading 50-50, does that mean out of every 10 trades you win 5 or you lose 5, or does that mean out of 10 trades, you've made 10 pips but you lost 10 pips, so you're right back at you're even. So I'm not really sure what they meant, because the fact of the matter is you could actually lose more trades number wise, but because your wins are so much larger than your losses, you're making money. And another thing in this edition, this magazine of Wall Street, they talk about how traders talk about they or them. But who are they? And it goes on to say, so the market student of a mathematical turn of mind is always seeking a rule or set of rules, a sure thing, as traders put it. And I guess I will have to admit, kind of guilty of that, because I like to win. So looking for different things where overall success, should be attainable. So for example, if we take a look at, let's take a look here. I think, is it here? Look at the buy zone. So here we are at the buy zone for today. There was never a long trigger. You had a short trigger here, could have exited for a profit. Another short trigger here, could have exited for a profit. Another short trigger here, you could made a huge amount. Now, then again, there's the weekly open crossover. Here was a couple of pips right here. Maybe you were within your tolerance, crossed over to the upside. There was a win. You crossed to the downside. There was a win. You crossed to the upside. That could have been 10 or more. Crossed to the downside. Once again, huge. Simple horizontal lines. I mean, or if you would have put some bias rules in, hey, if it's below the daily open here, but above the weekly, that's kind of what I used to call no man's land. You don't want to trade here, especially when they're close, because the market hasn't made up its mind. But you can see here, it made up its mind. That's one of those sets of rules. You know, the rat zone. There was no rat zone trading here, but here you could see we're in it, and maybe looking for a possible move to the upside. You can see here we got the smart rat, and then the regular rat, and then also just note the price in the launch pad, as I like to call it. Let's see, what was the other one? The wick zone. Once again, these, sure thing, mathematical turn of mind, using math, statistics. But the funny thing is, the quote goes on to say, says, he's talking about the market student. He would not seek such rules for succeeding in the grocery business or the lumber business. He would, on the contrary, analyze each situation as it arose and act accordingly. The stock market presents itself to my mind as a purely practical proposition. Scientific methods may be applied to any line of business from stocks to chickens, but this is a very different thing from trying to reduce the fluctuations of the stock market to a basis of mathematical certainty. You know, these are some, once again, this was February 1912, so over 100 years ago. And this magazine of Wall Street was, I guess, let's see, Wyckoff was one of the authors. But I just thought it was time maybe to revisit it because, you know, as traders, we sometimes look outside ourselves for the answer. But it's funny because one of the articles in this edition is called The Psychology of the Stock Market. And so even, over 100 years ago, because back then, once again, no, instantaneous charting, online charting, up to the minute price or up to the second, millisecond price changes. Oh, and just for the record, if you traders remember yesterday, remember I said there was an open gap that needed to be filled. I think it was even visible, yeah, right here on M15. Remember I said I was looking for opportunity to shorten that gap gets filled. Well, you can see right here, it got filled and then some. I'm not saying that to brag. What I'm saying is when you make these observations, do I know if it's going to work out or not? No. But, do I have statistics on my side? Yes. But it's kind of like the roll of the dice. Each roll is independent. And so each trade is independent. And it's just something that you need to always remember and never forget. So it's not that one trade, but it's, sticking to your plan, and over time should pan out. It's kind of like, the launch pad right here. Price turned around. What did we have? We had price crossing into the launch pad, closed above indicator 2 on M1, closed above indicator 2 on M5, and it shot up, and it could have been worth 50 or rather 10 or 15 pips. I mean, there was like an opportunity to take 10 here, and then maybe another opportunity to take another 10 in the second trade. Just following simple rules, sticking to the plan. Nothing you have to think about because the thinking's already been done in the method. So, fellow traders, I hope that helps. So, if you can ponder that quote, or the two quotes that I read to you, something just might click and it might make all the difference for you. Because I need you to remember and never forget, it's not what you trade, it's how you trade it. So go out there and drain the banks. This is the Rumpled One, over and out.